Hey, welcome back everyone. It is time for another red hot cover call video. Well, hey, look, in this video, we're going to update everyone on where I'm at with my using a high yield dividend paying fund. We're using QDTE and we're going to use margin. Now, I told you I was going to do this as an experiment because look, I haven't used margin for the most part in my entire trading career. But what we're going to do is this. We're going to do what all the craze on the internet is. Using margin to buy these high-yielding dividend-paying stocks to generate free and clear cash flow. I'm going to show you how we're actually doing it, but this was the video for which that you could watch at the very end where I set up this trade. This was the trade. I was going to use QDTE. It's a weekly dividend payer. It uses the NASDAQ. It writes daily out-of-the-money covered calls on the NASDAQ, collecting daily premium, and it distributes that weekly. We're generating anywhere between 22 cents and 30 cents per share per week, and it's turned out pretty good. This was the setup for that, and some things have changed. What I really want to highlight is that my margin debt has changed. We're going to talk about that in this video, but let's go ahead and get to this because I have some updates for you. If you like anything you hear today, I want you to subscribe to the channel. And hey, look, if you like this video today, bang that like button. It lets me know you like what I'm doing. And what I'm doing is this. I'm updating you on my buying a dividend fund. It's a high yield fund. It's QDTE. Now, I could have used any number of them, but we're going to stick with the indexes. I would highly not recommend that you use any of the single stock. I'm going to explain that in a members video here that you're about to see. But here's the deal. We're using the indexes because the indexes are going to move up and down nice and easy. We're not going to get that 1 month $5 dividend and then we lose all of that NAV in the dividend paying fund. And all of a sudden we're feeling like we're getting kicked in the ribs. Just ask any of the Coney, PYPY, even Misty investors. Yeah, that's right. Misty, for which everybody believes is the holy grail of yield max single stock funds. Yeah, that bad boy got down to 19 just the other day. Now, I get it. It's all based on the underlying stock, and MicroStrategies has exploded to the upside over the past 6 months, but it's also come back down to earth. Here's the problem with all that. You get involved when it's exploding, then you absolutely get caught in the rip curl that happens when they fall back. That's exactly what MicroStrategies did. We would never invest in such an underlying stock when we're talking about yield max funds. Now, I know a lot of people are like, well, since inception, I made all my money back. Yeah. But did you spend the money to live the good life? You didn't. You put it back in and you basically have more shares and now the stock's gone from where you got involved at 40 or 30 or even 20 and the thing fell to 19. So here's what we want to do. And I know somebody's typing right now, well, it's higher than 19 right now. Look, get rid of that single stock risk. Let's use any number of these. QDTE, XDTE, WDTE, or RDTE. Those are going to use indexes. They're going to do single 0 DTE trades. So they generate all that out of the money, cover call premium, and then they pay it to you on a weekly basis. Now let's go ahead and take a look at where I'm at. That's my opinion. Okay, that's my opinion. You may not agree with it, but what I'm going to tell you is this. A lot of those people that owned all of those single stock risks where they got involved at 20 and 21 and they were absolutely drinking the juice, now they have funds that are trading for half the price, if not lower. It absolutely feels like you're being compressed. Well, this is why I did not pick those. I went ahead and picked QDTE. Now, I probably should have picked the S&P 500 or WDTE or XDTE, but we went with the NASDAQ because I'm thinking, hey, NASDAQ might give us a little bit more movement, maybe a couple more pennies per week per share. Well, the NASDAQ fell, and when the NASDAQ fell, it fell some 13%. Luckily, QDTE only fell 11%, but here we are. So now, in the video you're about to watch, I'm going to break it down. Now, in the video, I am not celebrating the fact that I have all this buffer And my drawdown might be $7,100, and I'm trumpeting the fact that I'm collecting these near-term covered calls, but I have all this NAV erosion. Listen, NAV erosion, I get it. A lot of people want to associate NAV erosion with any move in the stock. So what are you telling me? Every single stock and fund, when it moves up and down, you get NAV erosion plus or minus? Come on. When the NASDAQ fell during this correction, so did QDTE. That wasn't NAV erosion. That was the markets moving, the NASDAQ moving. And now, of course, with the NASDAQ moving higher, QDTE is moving higher. So what are you going to call that? NAV rising? Come on. NAV distributions is what it is. Every single week or month, these high-yielding dividend-paying stocks will take from their net asset value, for which is cash. These use cash. Now, some of them use the underlying ETFs and they own them, but they use cash. Well, that's the NAV. And when they take from their cash position, they are taking from the NAV, or they're having a NAV distribution. Well, let's talk about some of these NAV distributions. So I'm going to break this down real quick. You're going to hear the video here at the end. Stick around. It's a members video. I sent this to the members 2 days ago. If you were a member, you would have gotten this. You would have gotten many videos. They are members videos for which only members get. You don't see them here on YouTube. We're trying to up the game. We're writing covered calls, selling cash secure puts so we can buy dividend paying stocks. It's the absolute golden goose of investing. Buying these things are not the golden goose, because at the end of the day, when you're at the 9 to 5 busting your ass, you got to ask for some money to buy some of these things, and it's never enough. But when you write cover calls and sell cash secure puts, you literally produce a golden egg of covered call and cash secure put premium profits for which we buy a dividend paying stock. We don't need anybody. We learn how to sell premium, write covered calls, sell cash secure puts. That's what I teach my members. I do paper trades, recently talking about that, because all of our accounts are wrecked, even yours. And if yours isn't, then hey man, we tip our hat. But at the end of the day, what I try to do is show the members how we can trade during market pullbacks. And we just had a correction. So selling premium is a bit tougher, but we can do it, and we're doing it. In fact, I just did 2 cash secured puts right now using TNA. And I'll tell you what, we're going to take all of that cash secure put premium and buy more QDTE or any of the index-based high-yielding dividend funds. Now, with that said, in the description is a 1 free month offer. Had 2 people sign up today, told me they want to be a part of the dividend tree idea. Sign up, 1 free month offer. Hey, look, I'm going to turn it over to him. I hope you enjoyed this. In the comments below, let me know other dividend-paying stocks you would use this strategy on. I hope you take something away from this video, and if you have questions, ask. People in the comments know they have experience with this. Stick around. I know you're going to like this one. Hey, welcome back, everyone. I want to give you an update on my QDTE on margin play. I want to give you an update. It's been about 1 full month. You know, I've been wanting to calculate all of this based on 4.5 weeks in a month, just so we can get an average, because some weeks are going to be 4 and some weeks are going to be 5. So let's go ahead with the 4.5 weeks per month, and here are the results. So what I want you to notice is a couple things, and we're going to talk about the margin itself here, okay? We're using QDTE. It's a weekly dividend payer, and for the most part, it trades sideways to higher. Problem is, I had bad timing, and when I got involved in this, we got involved when the markets were not correcting 10%. So the markets did fall, but this is going to be great for this example, because I'm going to show you how our non-margin buying power really helped out here. They call that a buffer. So when we got involved, it was February 28th. We went ahead and bought about 1,554 shares of QDTE on margin. I ended up buying a total of 2,000 shares. So all these numbers are based on 2,000 shares, and I wouldn't have bought QDTE in this situation had I not bought the 2,000 shares. So the way this worked was I had a little bit of cash. The brokerage took the cash first to buy the first set of shares, and then they came in with margin, which is about 61,000, and bought the rest of the shares. So I have 2,000 shares of QDTE. I'm going to consider that all on margin. These are the numbers. So on February 28th, we collect that dividend of $519. On the 7th of March, we collect $302. 14th is $466. And we just got the last one, $554. Now, that's 4 weeks of collecting dividends. I just got my first margin interest payment. So for borrowing this $61,000, it's going to cost me 8%. That's annually. They calculate that daily and they bill me monthly. So I got my first bill. It's $197. That's much less than I thought at 8%. If you're going to try this, you want to negotiate your margin debt payment down. Usually they start out at 12%. You can call them up, tell them you want something better. There's at least 5 brokerages out there that will start you with 6%. I negotiated down to 8%. They wanted me to put more money in, but as of right now, I'm not, so I get 8%. Now, with this experiment, I'm going to pay taxes as well. So I take out that taxes of 25%. We collect all the dividends. We pay the margin interest debt. We're also going to pay for the taxes. And when we do that, it's $1,185 in free and clear money. There is no more bills to be paid. That is free and clear money. Now, but that's also the risk, right? I am holding QDTE, so there is risk involved here. But that so far is the first 4.5 weeks. We collected those 4 dividends, we paid the margin interest, and we paid taxes. Now let's talk about the trade itself. I got involved with QDTE around $39.50. That's when the markets tailed off. We corrected by 10%. QDTE tracks the NASDAQ, so it fell further. In fact, the NASDAQ fell some 13 to 14%. So you could see right now it's recovered because see in the right, you see I'm down 9%. Well, we were down as much as 14% on this trade. That leads us into a very important part. Had I used all of my margin and not leaving myself any buffer, this would have caused a problem. I would have had to pay a margin call. When I took on this trade, I had all this money on margin. And when I elected to buy the 1,554 shares, that left me with $20,000 in margin. Now, what does that mean? When I own all of these shares and we put the trade on, I have $20,000 of margin buffer. The market can fall, or my account can fall some 20 grand before I get a margin call. What I want to show you here is this. Look at how I'm down $7,100 on this position. QDTE is trading at $35.82. My buy-in is $35.50. I am down $7,170, but look at my non-margin buying power. It moved from 20,000 down to now 17,000. Now, in the height of the sell-off, I will say this, my non-margin buying debt or my buffer fell down to about 15,000. I think it was 14,999. The market sell off some 10%, and I still had over 15,000 in margin buffer. So that's the important thing here. Learn about margin buffer. When you set up a margin trade, always go to the calculator. They all have a calculator. They all have a worksheet. You plug in, then you'll see what your non-margin buying power is, or what they call a buffer, and make sure you have enough. And think of that number as if the markets were to fall and my account were to fall that number, well, that's when I get the margin call. Also understand that this is QDTE, which has a 30% margin requirement. So what does that mean? When I put in $10,000, let's say, it only has a 30% margin requirement. So I can actually borrow up to 3 to 1. A lot of these yield max funds and some of these yield max plays, they're more like 40 and 50% requirement. So that means you have to have 50% of the capital to do that trade on margin. So you'll understand this the more and more you get involved. The margin requirement is all about what is the equity's margin requirement. Say, for example, I wanted to use margin on a TNA trade. That TNA margin requirement guaranteed is going to be 100%. That means if I have $10,000 in there as collateral, they're only going to let me borrow to $10,000 due to the margin requirement. And that's all going to be based on your brokerage. For me, using QDTE as a 30%, that means I could borrow much more, and the requirement of capital is 3 times as less. This is why when I had $20,000 in margin buffer and the stock fell some $8,500 at the bottom, my margin buffer only moved about $4,000. Very critical, never got a margin call. Now the markets are moving sideways to higher. They're finding a bottom. Month after month after month after month, it won't take long before the money stacks up. I either pay off all of this margin balance, or if QDTE gets to $39.50, then I'm just going to cash out and all the money's on the table. See, what happens is you have no cash in a margin account. When this money hits the account, Fidelity immediately grabs the money and pays down your margin debt. And that's okay because I'm not using this for that purpose, but do understand that's how it works. The idea is I could pay this entire amount off and I would own all of those shares free and clear. Well, hey, look, this is only the first month. We're going to do this more and more, and I might throw more money at this project if this proof of concept works out and over the next 2 months I make this kind of free and clear money. We are going to leverage up and do it again. Hey, look, be safe, be healthy, most important, be lucky. Until next time, may all your covered calls be profitable.